So what if there was like a simple, really powerful secret to building lasting wealth? A truth that's, well, so fundamental, but maybe the financial industry often kind of overlooks it.
Maybe conveniently overlooks it.
Maybe. We're talking about cutting through all that market noise,
Yeah.
the complex charts, the jargon, just finding some basic liberating truths about investing.
It almost sounds too good to be true, right? But that's pretty much the core of Jack Bogle's billion-dollar lesson we're diving into today. It's this incredibly simple, yet profoundly impactful approach he pioneered.
Yeah, the whole index investing thing.
Exactly. And his methods haven't just saved investors billions, literally billions.
hmm
They've genuinely helped millions grow wealth with, honestly, far less stress, and often with better results.
That's the key, isn't it? Better results with less stress. So today's deep dive, it's all about Jack Bogle, his groundbreaking philosophy. We've really gone deep into his big book, Common Sense on Mutual Funds.
A classic.
Absolutely, pulling out the key ideas. But we're also connecting his, well, very practical advice with the sort of timeless foundational stuff from Benjamin Graham's The Intelligent Investor.
Another giant. So it's a blend of Bogle's common sense and Graham's deep wisdom.
Right. Get ready, because this mix, it can genuinely change how you think about your money, how you approach investing.
Okay, let's start with Bogle himself. The recognition he got was just immense.
Yeah, I mean, Fortune called him an investment giant of the 20th century. Time put him in their 100 most powerful and influential people. Institutional Investor gave him a Lifetime Achievement Award.
That level of recognition, it tells you he wasn't just playing the game. He fundamentally changed it. He was a real disruptor.
What was he disrupting exactly? What problem did he see?
Well, what's really striking is that he didn't just, invent a new product. He went right after a core systemic conflict in the traditional mutual fund industry.
Which,
He saw that most fund management companies are set up to make profits for themselves. And when that profit motive clashes with their fiduciary duty, their duty to act in your best interest as an investor, well, Bogle put it bluntly, greed wins and profits triumph. He saw the investor often coming second.
and it wasn't just the profit motive itself, but how it played out, right? He talked about how active funds focus so much on marketing, on high fees, rather than solid investment management.
Precisely. He saw this massive spending on advertising to pull money in, charging hefty fees, often for, well, pretty mediocre performance in the long run. It was more about selling the dream of beating the market.
So what was his answer?
That leads us straight to his revolutionary solution, Vanguard. The Vanguard model is pretty unique. It's one of only two major fund companies, TIACRF being the other, that operates without a profit motive.
How does that even work? No profit motive.
It's this ingenious mutual organization structure. Basically, if you own shares in a Vanguard fund, you, along with all the other shareholders, collectively own the management company itself.
Ah, so the owners are the customers.
Exactly. Bogle's mantra was, treat your customers as if they were your owners, because they are our owners. Simple, but profound.
And the practical effect of that structure, that's where it gets really interesting financially.
Oh, absolutely. It lets Vanguard operate at costs. Bogle estimated about 75% below industry norms. 75%.
Wow.
He figured this saved shareholders upward of $3 billion per year. And someone like Warren Buffett. He thought if the whole industry adopted it, the savings could easily top $30 billion each year.
Just imagine that. $30 billion back in investors' pockets every year. Okay, so that's the structure, the company. But what about the investment idea itself? The simple secret.
Right, the core investing philosophy. It actually goes way back to his Princeton thesis in 1951. He explored this, well, radical idea back then of just matching the market instead of trying to beat it.
Which sounds almost passive or unambitious, maybe,
Yeah.
especially compared to the Wall Street image.
It totally does, especially when everyone's yelling about the next hot stock or the genius fund manager. But that thesis idea eventually led to the launch of the first index investment trust in 1975.
That became the Vanguard 500 Index Fund, right?
That's the one, just holding the 500 biggest U.S. stocks. And yeah, initially people laughed. It was derided for years, famously called Bogle's Folly.
Folly turned out pretty well, though.
You could say that. It became one of the largest mutual funds on the planet. The core theory is deceptively simple. All investors, as a group, cannot possibly outpace the total cost-free return on the entire stock market. You just can't, mathematically.
And a huge part of why index funds work so well comes down to costs, low costs.
The unavoidable power of low costs. Bogle called it the tyranny of compounding when talking about high costs. Even tiny differences in fees compounded year after year. They lead to increasing and finally staggering differences in how much money you end up with.
That phrase, tyranny of compounding, it really sticks with you. It's like this hidden force working against you if your costs are high.
It's insidious, totally. Let's put some numbers on it. The cheapest index funds might charge, what, 0.2% a year? Maybe even less now.
Right, incredibly low.
Compare that to the average active fund, maybe 1.5%, sometimes way higher, like 2.2% or more. But wait, there's more?
Uh-oh. Hidden costs?
Exactly. Active funds trade a lot. That's called portfolio turnover. They're buying and selling constantly. Average turnover can be like 80% annually.
Meaning they replace 80% of their stocks every year.
Pretty much. All that trading racks up brokerage commissions, bid-ask spreads, hidden costs that can easily add another 0.5% to 1.0%, maybe even more, to your total expenses.
So you add the expense ratio and the trading costs.
And suddenly, the average equity fund can have this aggregate fiscal drag, as Bogle called it, of maybe 3% per year or even more.
3%. If the market returns, say 10%, that's nearly a third of your return gone before you even see it.
Precisely. Let's make it concrete. Say you invest $10,000. Over 25 years in a moderate market, maybe the index fund gets you to $30,900. The average managed fund, after those higher costs, maybe only $24,000.
It's almost $7,000 just vanished into fees and trading friction.
And now stretch it out. This is where the tyranny really kicks in. 40 years, same $10,000 investment, that index fund, could grow to, let's say, $931,000.
Wow.
The managed fund, fighting that 3% drag year after year, it might only reach $217,200.
Wait, 900,000 versus 200,000? That's staggering.
It is. Bogle calculated that in that scenario, the managed fund investor only accumulated 23% of the projected capital. Most of the potential wealth was eaten by costs. It's silent erosion over decades.
Okay, so costs are huge. But it's not just costs, right? Indexing also tends to win on performance and risk.
Generally, yes. If you look at broad market indexes, like the Wilshire 5000, which is basically the whole U.S. market, or the S&P 500, they consistently beat the average active fund manager.
By how much?
Well, the Wilshire 5000 outpaced the average diversified equity fund by about 2.5 percentage points per year over one 15-year study Bogle cited, and his original Vanguard S&P 500 fund. Over 15 years, it beat 94% of all diversified funds before taxes.
94%.
And after taxes, it beat 97%. Taxes are another killer for active funds because all that trading generates capital gains.
Ah, right. Index funds, because they don't trade much, are more tax efficient.
Hugely more tax efficient. Plus, the risk factor. Broad indexes are inherently diversified. You own a tiny piece of everything. Morningstar found index fund risk was more than 30% below the risks assumed by actively managed funds over one 5-year period.
So often better returns, lower risk, lower costs, better tax efficiency. It seems almost too easy.
Which brings us back to Bogle's core message. Simplicity is the ultimate sophistication. He literally said, the secret of investing is finally that there is no secret.
Just follow a simple plan, own the market, keep costs low, and let compounding work for you, not against you.
Yeah.
Ignore the noise.
Exactly. And it's funny, Benjamin Graham said something similar decades earlier in The Intelligent Investor. He was wary of complex formulas.
What did he say?
He basically said, the more elaborate the mathematics, the more uncertain are the conclusions. He felt that dependable calculations about stock values rarely needed more than simple arithmetic or the most elementary algebra. Keep it simple.
Okay, if it's so simple and effective, why do so many people, and the industry itself, chase active management? Why the illusion?
Well, a lot of it boils down to short-term thinking. Both investors and fund managers often get caught up in this rapid turnover game, constantly trading, trying to time the market.
Chasing performance.
Chasing performance, reacting to headlines. Graham called investing based on forecasts a fool's errand. He said expert predictions were often less reliable than flipping a coin.
Ouch. But active management relies on prediction, right?
That's the paradox. It's built on trying to outsmart a market that decades of evidence show is incredibly difficult, if not impossible, to consistently outsmart, especially after costs.
And then there's that reversion to the mean thing you mentioned, the gravity of the market.
Yes, this eternal force of gravity. Things that do unusually well tend to drift back to average. Things that do unusually poorly also tend to drift back up.
So past performance really isn't a guarantee of future results, like at all.
Bogle was emphatic. No evidence, none, that superior past performance is predictive of future success. He cited a study of top-performing funds from the 90s.
Uh-huh.
Of 99 top quartile funds, 72 of them, that's 73%, performed at or below the S&P 500 index in the next decade. They reverted to, or below, the mean.
So chasing last year's winner is usually a bad idea.
A demonstrably bad idea. Think about the famous Legg Mason Value Trust. Unbelievable run, beat the S&P 500 for 15 years straight, 1991 to 2005. The manager was a legend.
15 years is incredible.
It is. But then, from 2006 to 2008, it fell behind the index by, wait for it, an astonishing 43 percentage points.
Whoa, reversion hit hard.
Like a ton of bricks. Even the best aren't immune forever.
What about things like Morningstar stars? People love those ratings.
They do. But here's the kicker. Morningstar itself candidly acknowledges their star ratings have little predictive value.
The company that makes the ratings says they don't predict the future.
Pretty much. And other studies, like one from the Holbert Financial Digest, found that a strategy of buying 5-star funds and selling them when they lose the 5th star actually produced below-market returns at above-market risk.
So chasing stars is worse than doing nothing.
Often, yes. It just leads to more trading, more costs, more taxes, based on data that even the provider says isn't predictive.
It really all comes back to controlling your own behavior, doesn't it? Like
Yeah.
Graham's idea of the market as a pendulum.
Exactly. Graham's metaphor is perfect. The market is a pendulum that forever swings between unsustainable optimism, which makes stocks too expensive, and unjustified pessimism, which makes them too cheap.
And the intelligent investor.
Is a realist who sells to optimists and buys from pessimists. Easier said than done, of course.
Right. It means ignoring the extremes.
And accepting fluctuation. Graham said the investor with sound stocks should expect prices to bounce around. Don't get scared by drops or euphoric about surges. Market quotes are just information. They're for his convenience, either to be taken advantage of or to be ignored.
Don't let the market's mood dictate yours.
Pretty much. His simple motto flowing from that was never buy a stock immediately after a substantial rise or sell one immediately after a substantial drop. Basic but powerful behavioral advice.
So wrapping this all up, Bogle's billion-dollar lesson. It's really about common sense winning out over hype, right? Experience over hope.
That sums it up nicely. The core truth, backed by data, reinforced by Graham, is that low-cost, broad index funds reliably beat most active managers over time, especially after costs and taxes.
And understanding that tyranny of compounding, how those seemingly small fees are actually a massive economic drag that can quietly siphon off a huge chunk of your potential wealth, that's crucial.
Absolutely. Knowing this gives you, the listener, the power. The power to sidestep the hype, avoid the costly mistakes, and build your financial future with, frankly, a lot less anxiety.
You can choose a path aligned with long-term wealth building, not just chasing shadows.
Right. So here's a final thought to leave you with. Just imagine, what if the entire investment industry truly embraced Bogle's principles? Transparency, low costs, simplicity, putting the investor genuinely first.
Instead of chasing that elusive alpha or superior performance.
Yeah. What would that shift mean for the global economy, for collective wealth? And maybe most importantly, what could it mean for your individual prosperity if everyone just leaned into this simple, powerful billion-dollar lesson?